Well, happy Friday, everyone. I'm Dave Weisberger, the CEO of CoinRoutes, and it's time for This Week in Crypto. Today's Friday, September 23rd, and I'm filming direct from Messari's Mainnet conference, where several thousand people interested in all aspects of crypto, from running your own node to what's going on in Web3, new developments in the market, and of course, it being Messari, research and data and understanding what underlies crypto projects are all being discussed. Everything from that to firesides with CFTC, Commissioner Pham, and a live stream with Vitalik Buterin and the head of Zcash. There's been a lot that's going on, and the content's been interesting. I even got into the act by talking about the history of markets, and all of this will be posted on our website at some point soon. Now, let's dive into what's going on in the marketplace. The markets this week, as you probably know, have all been selling off. What is incredibly interesting is just how correlated risk markets are. Bitcoin, NASDAQ, and the Russell 2000 are all down between 12 and 13%, have been moving more or less in lockstep for the last week. Obviously in response to the continued rise in rates from the Federal Reserve and comments by Chair Powell that he doesn't care if risk assets go down. In fact, in some respects, he obviously wants it. It was interesting because I was listening to Bloomberg Radio this morning, and they were surprised to see the yield curve going inverted. What's really interesting is why would they be surprised when that is extremely obvious that that's what the Fed wants to do. They want the long end of the curve to stay low, and they want the short end of the curve to go higher. Why both? The long end has to be low so the government can afford to fund its massive deficits. Otherwise, all discretionary spending will be squeezed out. The short end of the curve they want higher to stop consumer demand and squash it so inflation will come down. But people are surprised by this. Now, most people would say that inverted yield curve is an indicator of recession. Sure, almost certainly what's happening, and that's why risk assets are selling off. What's amazing about all of them, however, is everything is still in the trading range that was carved out by the original June low. So, in truth, as much as the markets have fallen, no fireworks have happened as of yet. It is also worth talking about the Ether dynamics, because Ethereum has actually fallen a little bit less this week. Yeah, not a lot less, like 10 to 11%, but still noticeably less. Why? Mostly because it got hammered last week after the merge. Why did it get hammered? Well, the dynamic, which I'm not taking credit for because I didn't know it was going to happen in advance, was that the GPU-based miners in Ethereum had to sell. They had inventory. It seems like they waited for the merge, hoping that they would be able to sell to a flood of new buyers, happy to see that Ethereum was now proof of stake with lower environmental impact. But the truth is that none of that buying really materialized. Obviously, in a bad market for risk assets, it's understandable, but it's also true that Ethereum has we're not proven yet that it's going to get to more scalability, that gas fees are going to go down, or that the use cases that people are depending upon are going to materialize. NFTs, which fueled Ethereum's rise to its all-time high, are down over 90 to 95% in terms of volume traded. And while the values of a lot of NFT groups haven't fallen nearly that much, the volumes are down, and the volumes are what drives need for the blockchain. So all of that is going on. But the bottom line, as far as the markets are concerned, is speculators are still in firm control. Long-term buyers are still waiting on what's going on, and given the confidence-shaking impacts that we've seen, and I've discussed in previous weeks, none of that is terribly understanding. So what's the news for the week? First, the good. NASDAQ has decided they want to offer an institutional crypto product and made a big announcement. They have very interesting partners, and it is something that could matter, and in weeks where there were animal spirits going and people were excited, would probably have fueled a rally. But at the same time, the SEC came out with more guidance. Now, this is a retread, but it's still something that's very important, because what they are suggesting is that crypto assets held by banks in custody should be treated as liabilities on their balance sheet and not as assets. That is very cost prohibitive for banks. It means their balance sheet cost for custody will be very large. It means they'll have to charge an enormous amount. More or less, it makes banks much less competitive with crypto native custody firms, and that is a problem, because a lot of the largest pools of capital only want to be custodied by entities that they can trust with enormous balance sheets like the big banks. Plus, there's an entire group of potential crypto investors that are worried about self-custody, because they think that if, let's say, it was me and I had everything in my own wallets and something bad were to happen to me, what would my wife be able to do? Would she be able to figure out how to access that? Maybe, maybe not. There are a lot of people who are concerned about that sort of thing. So the custody business is still integral to crypto's global acceptance, particularly important in the United States. With all of this said, it's getting harder and harder to look at Chair Gensler as doing anything other than a war against Bitcoin and a war against crypto. The denial of the Bitcoin ETF, which is going to court now, along with this, is basically his way of trying to keep investors that are less sophisticated away from the asset class. What's interesting about that is, and I will repeat this almost every time we talk about it, is that Bitcoin is definitely more used by minorities and poorer people than the aggregate of other investment classes. So in a sense, it's his elite war against the common person. The last comment I'll make is I was in Canada earlier this week for a Best Execution Industry Conference. 200 people, senior business leaders from a variety of firms in Canada. But what was fascinating was that one of the lead people at both IROC, Canada's FINRA, and the OSE, Canada's SEC, were in attendance and spoke. Both of them were extremely practical, both of them focused on crypto, and in both cases are open to crypto being an asset class treated with the same principles as traditional asset classes, but with rules tailored to work for digital assets. That approach is completely different than the SEC and incredibly refreshing. I don't know that it's possible, but it would be great to see the US emulate Canada for a change. Well, that's all for today. Have a great weekend and stay safe out.